Okay, so in this video clip, we are going to run through how to pull in data from Yahoo Finance, and we'll have a look at some cryptocurrency data also scraped from Yahoo Finance using some, well, at least initially, some Pandas command. And to set up again, we're in the Colab, we're running Pandas Python code, and we're going to pip install Pandas Reader, which we'll use then for reading in information from, in this instance, Yahoo Finance. And later we'll also use, I think it's yfinance as well, that package. But just for the moment, we're going to pull in just a couple of stocks and view them as a time series. And we're going to import in Pandas as PD, just to load up these general libraries. So Pandas, datetime to give us a date today. So we want to be able to identify what today's date is. We'll see why that's relevant in a moment. Matplotlib for graphing, NumPy for mathematical operations. And we'll set out just a template figure size of 16 to 8 in dimensions for our graph. Okay, so we load in those libraries, and then we're going to import in Pandas data reader, and that's going to do some of the work here. Pandas data reader import data, and we'll get the version. If we run this command, that'll bring back the version that we have. And then if we're searching for a particular stock, and for instance, here we're going to pull in Apple, Amazon, Microsoft, Google, but we may not be aware that this is the ticker for Apple. So we could just go into this URL and we could look for APPLE, Apple, and you see we're getting the ticker here for that stock. If it was Microsoft, try it again, Microsoft, and again we get the ticker for that, and that's the way we will read in the Apple, Amazon, Microsoft, and Google, or Alphabet. Again, if we put in Alphabet, which is the overarching umbrella company for Google, Alphabet, right, you can see it's Goog, right? Okay, so those are the 4 companies. We could put in more, but we're just going to go with 4. And we're going to say the start date is 2000. It's the 1st of November 2000. And the end date is today. And then the stocks start with Amazon, Apple, Amazon, Microsoft, Google. And then we'll use, we create a data set using this data get Yahoo, and then the ticker, which we've identified here. These are the tickers. And then we have the start date and with the end date, right? Which is the 18th of April, 2021, 18th of April, 2021. Okay, so we've loaded in our date, start date, end date, and the tickers. And then we're going to get the data, and we're going to create an object called DT, and then we can take a look at that data. Again, and the start date then is the 2nd of the 10th, 2000. So 2000 November 2nd, 2000 November 3rd, or should I say 2000 October 2nd, 2000 October 3rd, and so on. To get the tail, it's the most recent. So Friday was the 16th, yesterday was Saturday, today Sunday is the 18th. So we don't have data for yesterday or today, and that's what we might expect. And if we want to get more observations, maybe we want to get 10, right? We can make a little adjustment there, and we get the 10 days, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And then we want to do some graphing, and we're going to go with the template figure size that we put up before. I'm going to get the close price. So again, maybe here we've, if we can have a look, we have adjusted closed and closed price. So we're going to pull in the adjusted close. So DT, that's the name of the object, all the data. And then we're just looking for the adjusted closed price for Apple, Amazon, Microsoft, and Google. And we can run that. And then you can see Google kicks in here in 2000, probably 2005. And we can see how the stock price evolved over time. Amazon went sky high. And this is the progression of Microsoft and Apple. Okay, and we can do the same again, but for the close price. But as far as I can see, it's almost the same. Right, doesn't appear to be a huge difference. Maybe there wasn't dividends that distorted, didn't create a gap between the adjusted close and the close price. Right, so that's a nice way of viewing the stock price change, so the price of the stock over time. And we can then import data read as PDR. So the example below reads in 5-year or 10-year constant maturity yields on US government bonds. Okay, so in this instance, okay, before we used Yahoo Finance, we read in the data from Yahoo. And again, if we're looking at, let's say, Google here for a moment, we've the Google stock price. It's currently, let's go back one. It's currently, so Alphabet 2,297. And when we look here at Google 2,297, so that's what we have. And again, this is Sunday night, and we can look at going back to, well, maximum would bring us back to, looks like 2004, that period. And that's the stock price evolution over the term, right? So we double click, we get a bigger interactive screen. Now, what we've managed to do with our Pandas reader is just pull in 4 stocks at a time, right? So we can scrape quite a bit of data at any one time, then set up in the Pandas environment and output a graph. Another very good source of data is Fred. Fred is the Federal Reserve of St. Louis's database. So Fred and Federal Reserve St. Louis, right? And it's they compile a lot of data there. And it's a very rich resource for all kinds of, in particular, macroeconomic data, but also some financial data, some applied volatility series. But typically, we're getting money measurements, GDP, inflation, unemployment. So a lot of macroeconomic data in here. And in this instance, we're going to pull in data relating to 5 years of 10-year constant maturity yields on US government bonds. And it's GS10. So maybe we'll just do a quick copy selection and see if we can find that here. Just Control V and run. And it tries 10-year Treasury constant maturity rate. So view 10-year yield estimated from the average yield of a variety of Treasury securities with different maturities derived from Treasury securities. And we get some data up. And so it's the 10-year Treasury constant maturity rate. Okay, so if we look at the Fed funds rate or look at other interest rates, we do get a similar evolution that in the mid-1980s, we got this very substantial peak that occurred. The Federal Reserve under Paul Volcker implemented a change in the monetary regime, start targeting the money supply, and interest rates went very dramatically up, in specifically the Fed funds rate, but all the rates in the system, including the 10-year Treasury constant maturity rate. Okay, so that's an adjustment that's introduced in, so we get a constant maturity rate for the 10-year Treasury yield, right? And we just have that here. Now, it's nothing too specific here, but just to demonstrate that with the Pandas reader as PDR, we can read in Fred data, and it's a nice way to do that. We can also read in data for housing starts. So housing starts from Fred. The example below uses month-over-month growth in US housing starts that has not been seasonally adjusted. The seasonality is evident by regular patterns, peaks and troughs. We set frequency of time series to MS. Okay, so we'll just run that, and maybe I should make sure that I've imported this in. And then let's execute. So the data is equal to PDR, data Fred, and that's the series starting and going up 2019 and the 1st of the 6th, so June 1st and January 1st. Okay, and we've got the percentage changes. We've dropped the NA, so where cells are not populated, we dropped those. And we multiplied by 100. Okay, so again, it's a nice graph. Now, it's not really stock price data, but it is, I suppose, macroeconomic data, finance data, and in addition here, S&P 500. So this is import Pandas reader PDR, and then PDR get data Yahoo, and this is the S&P 500 index. So if we look up again, if we go back to our the ticker lookup, right, and double click and then put in S&P 500, you see we get this symbol, and so we can that's the S&P 500. We can come down here and look at the S&P 500. We'll read it in from Yahoo, and then we'll look at the last, the first 5 observations we have in our data set going from 2004-11-01. And if we look at tail here, TAIL, again, we observe that brings us up to the 16th of the 4th, so April 16th, that's Friday. Today is Sunday. So it brings us right up to the day, starting date, the 11th. So November 1st, 2004. And again, we might go with head, just to take a look here. HED, execute again. And if we wanted the first observation here, so we could go ILOC 00. So S&P, the name of this object that we created was S&P 500. If we wanted to get the first, just execute. And if we put in here 1, you can see that this value is the same as this. If we put in 1 here, we get 1127, 1127. So it's the 1 over. If we wanted to put in 2, right, would bring us over 1 more again. So 1130, 1131, 995. And if we went 1, 1, okay, it should give us 1128. So this value here, 1128. So the apex cell is 00 here, 1122, 33, 44. Let's take a look. 4, 4, and if, which would be this one here, 17244, 45. So Roman Catholic row column should be this cell here, 166, 166, 17, 17. Okay, so S&P 500 tail we looked at before. And if we wanted to, for instance, gets so the 8. Now let's put in here 12, 1, 2. So to be compatible with this date here, and the open value should be this. So S&P 500 open for 2021, April 12th. We will get 4124.7099, and again that lock syntax available in Pandas allows us to narrow down or filter cell. We can do more filtering according to some criteria. So we might say we want to take a look at data from the 6th, right? So greater than the 6th. So that'll have a few more days. So it's the 7th, the 8th, the 9th, the 12th, the 13th, the 14th, the 15th, and 16th. That would be Friday. Okay, we could adjust that to be, let's say, 10. And that'll give us then 12, 13, 14, 15, 16. So let's run again. Okay, 12, 13, 14, 15, 16. So we can manipulate and filter our data according to the index here relating to the date. Okay, maybe want to print some information relating to the index, float, so on, see what kind of numbers, look at the shape of our data. So remember, rows, columns, 6 columns, 1, 2, 3, 4, 5, 6, and then we have 4,143 rows in all. Okay, so we only see a subset here in our Pandas notebook. To get some descriptive statistics, we can say take that object S&P 500, describe. We get a high and a low, the open, the close, the volume, and the adjusted close. So basically the different prices and the volume, and then we get the count, all are the same. The mean values roughly similar, standard deviation roughly similar, except for the volume, of course. Standard deviation, these are roughly the same except for volume. And then we can look at the percentiles, the minimum and the maximum, and the breakdown of the percentiles. And finding the first and second moments is getting the mean and the standard deviation. And we're saying, look, print the mean with 3 decimal places. Same for the standard deviation. The variable in question is the S&P 500 volume. So the S&P 500 volume, this index, but there's 4,000. Keep in mind, we have 4,143 observations, and we can take a high value, which would be, we could take the mean and then add on 2 standard deviations, and then look at what proportion, how many of our observations exceed that high value. So it's a kind of high watermark. So if we take the mean value of the volume and take 2 standard deviations and add on, that would bring us up to quite a value that would be relatively beyond, right? 95%, in excess of 95% of the time, we should be here. In fact, 97.5% of the time. But in fact, what we observe is when we take the length, in other words, the number of observations that satisfy this criteria, and divide by the total number in our data set, then we get 4.5% exceed the high value. So it's a kind of a measure of dispersion, and we breach the 2 standard deviation quite a bit here on the upside. Okay, S&P 500 and sort values, we can go from the highest to the lowest to the highest. So the highest volume is down here. and that was coincided with the financial crisis, I presume. And we can filter according to a given date. So we can look at 2010-056, it's this one here. And we're looking at, it'll just give us the readout of exactly everything that's here in the row, right? We want to do a little bit of graphing to get some kind of distribution. So we use a histogram, and we can have a look here at the volume. And we can see that there's a little bit of more on this side, but more skewing, right, in terms of, and they, again, 1E10, to look at that, what that represents. So 1E10 is quite a substantial number. If we execute that, we can see it's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 10 zeros after the 1 here. And we're close to, we have a lot of skew here beyond 1, right? So that's 10 zeros. Okay, so for box plots, to get a sense of what a box plot is, then you could go into Wikipedia, and that gives a bit of a description. I might leave that. But what we have here, obviously, volume is soaking up all the distribution, so we might exclude the box plot with volume. Just look at high, low, close, adjusted close. And then we get, if you like, the interquartile range, and then 1.5 times interquartile range. And when we go beyond that, we're beyond the whiskers, if you like, and we have the true outliers. Okay, so we have some outliers on the upside, as might be expected with stock prices. We get a bit of skew, and we can introduce a new column, right? So if we look before, this is what our data set was made up of for volume. And here we can take for volume, but for the S&P 500, and you notice we have 1, 2, 3, 4, 5, 6 columns. I'm going to create a new column, and it's going to be created using what? Using the percentage change of the close price. So we're going to take the closing price and take the percentage change. When we include that in, you can see now we've 1, 2, 3, 4, 5, 6. So the close price and the percentage change is yielding us this value here. Okay, and the first one obviously is null because there's no percentage change can be calculated for this cell. But that's a nice way of adding in a new value, a new column based on existing columns. And we can look at the, if we look at the tail, we'll be missing no values. So tail, run here. But we're probably better off going with the head. Okay, so the most recent values, right? Sorry, the values at the beginning. Dow Jones industrial average. Let's execute. We pull in using this PDR get Yahoo Dow Jones 30, starting in November 1st, 2004. We take a look at the initial values, and the tail would bring us up to today. Let's look at that. Tail, execute, and that's up to Friday. Okay, so the most recent available value from Yahoo Finance. And then we can merge. We can take the Dow Jones series and the S&P 500, put titles on those, and then take the close price and the S&P 500 close price and put those together, call it close, and look at the close head. So Dow Jones 10,054 2004, right? That was the close. 10,054 38, 10,054 38. So there we can see they're the same, right? And then we can say S&P 500 after 2019, and we can resample, take the mean value, and I've done a few more. Okay, and then we can use yfinance, which is a package in Python. So just to take a look at yfinance for a second, yfinance is a package. Probably should use Google to search that out. Okay, it's and we copied this and then we pip install, right? So there's a package for ever since Yahoo Finance decommissioned their historical data API. Many programs that relied on it stopped working. Yfinance aims to solve this problem by offering a reliable, threaded, and Pythonic way to download historical market data from Yahoo Finance. Okay, so Yahoo Finance is quite a nice way of retrieving data. We're going to do the pip install, import in yfinance. Now what it offers is this additional information sometimes. So we're taking the Apple stock data, but it provides us with a lot of data, right, that can be read in. And that's particularly useful for stock prices. So things like stock splits and so on might be useful when we're looking at the historical data, and might account why some stock prices are higher than others. So Apple, for instance, Apple stock has split 5 times since the company went public. The stock price split for 4-for-1 basis in August 28, 2020, 7-for-1 basis on June 9th, 2014, split 2-for-1 basis on February 28th, 2005, and June 21, June 21, 2000, and June 16, 1987. So we've had all those splits, but we can check that, verify that's true. That's something that I took from Yahoo Finance. And you can see I'm getting that from the yfinance package. It will retrieve the dates of the splits, and you can see it's consistent with what I got from Yahoo Finance. Okay, we can specify date range, snippet below, right? So yfinance download Apple data start date, end date, and you can see here we have daily data going back to 2000, and we can do tail if we want, right? Using the Panda syntax, right? And I have tail down here again, and tail here. I can change that back to head. And we can plot Apple share price over the period. So we can look at the stock price went really up in recent times, especially from, there was a crash, not quite a crash, but you can see in 2008 there was a bit of correction. Then after 2013, 14, some adjustment here in 2017, 18, some adjustment. And we see that, but the trend has been kind of exponentially going up over time. Okay, I'm going to leave that there, and the rest of the workbook, including some crypto, candlesticks, using MP, so it's a Matplotlib library for finance, and it's useful for doing candlesticks, where the stock price up and down, and again, look up candlesticks. It's a useful way of representing the stock price progression, and I have some data then related also to cryptocurrency, and I leave there for people to check out, right? And in recent times, there has been a fairly significant increase in cryptocurrency, with Bitcoin going up to 60,000. Bitcoin is represented on this side, all the others on the other side, and follow the links, and you'll be able to go to that.